Welcome to another episode of Business Redefined. Q3 numbers from the banking sector are flowing in, and we are privileged to have KCB Group Chief Executive Officer, that is Mr. Paul Russo. Paul, as always, tunashukuru.
Thank you, Julian.
Asante sana. Paul, one of the market watchers told me that all my interviews with KCB start on a low note. Let's begin on a high this time. Congratulations on the top line for Q3. Quite impressed by the turbocharge I saw there. And I don't think many have realized that you are at 90% of your full year 2022 earnings. If you just added, 13 billion, you would have blown it. What drives this turbocharge?
I think, thank you. Many times when people see the bad news, and it's always on profitability, they would not go through, quite the other numbers. So if you look at even the half-year results, the top line was actually growing very well. But the bad news of additional aggressive provisions and therefore the year-on-year reduction on performance did dampen the mood. But look, our top line growth has always been, Kenya is consistently one of those entities that you believe, even with the NPL discussions, and I'm sure we'll tackle that, we're starting to see the value of cleaning up the corporate book. And the retail team is obviously doing extremely well, but also the value on some of the high-risk decisions we've taken around the G2G, particularly on trade, starting to pay. But look as well, our subsidiaries, quietly, work that we did in 2019 to clean up that are starting to pay. The run rate Tanzania has with a below 5% NPL potential is massive. The risk we took, the decision of acquisition of BPR in Rwanda, starting to show. And TMB, even before we've taken the actions that we want to take, demonstrating value for that. But one I'll single out is Uganda, because for a while it's troubled us. So we seem now to have got Uganda right and with a good momentum. But I will still bet on Kenya.
Never mind the headwinds.
Never mind the headwinds. I'll still bet on KCB Kenya.
Paul, still on the top line discussion, whereas we must commend you for that, your costs are escalating much faster, squeezing out your margins. If you look at your cost to income right now, it's a bit disconcerting.
Yeah, so I think if you strip out one-offs, it's gone up by 15%. So I'll agree with you, it's not acceptable, right? But I think it's important for us to strip off the one-offs. Remember, we've quietly, and many people don't notice, is we had a voluntary early leaver scheme that we've delivered that. What I really want to see is staff productivity checking up, as well as ticking up, and that is a factor of a number of items. However, barring one-offs, it's a 15% increase. Remember, TMB was not consolidated, so you're comparing year on year. But I'm still not happy on that percentage. And there are a number of items that will need to come through. One is building a true shared service model. So we are now in that position as an institution operating in 7 countries and given our size, that we must run a true, capable shared services model. Number 2 is our investments in technology need to check in. We've spent quite an amount of money, particularly on systems, that I need to start seeing value out of that. So you're right, absolutely, that it's up. But I really want you to see the 15%, and we will bring that 15% down for sure. And 8 to 10%, I can take that. But our 15% is still on the higher side.
Okay. And as you celebrate subsidiaries, one of the dim spots there was NBK. Do you look back and see sometimes maybe this acquisition might not have been the best choice?
So I'm a very Julians, you know me, I'm very bold and I can say certain things because they're the right things to say. So I've said investors never approved of KCB acquisition of NBK. I'm also on record saying that investors gave us a benefit of doubt when we turned it around. Knowing and with the promise that we were going to do a lot more on efficiency. We'd started that. Deploying T24 will go live before end of the year. It gives us opportunity. Like I said, January, February, a KCB customer should be able to be served in an NBK branch, and an NBK customer should be served in a... That gives you opportunity to optimize. Because then you can remove overlaps. It's something everybody will ask you. You know, why are you running 2 branches in Wajir? Why are you running 2 branches in Mandera? But you need a technology capability if that's the direction you want to take. I think it's important, Julius, to clarify. When we took over NBK, we found that it was going to be extremely punitive to replace the core banking system at that point. So we chose to run down the contract for the core banking system. But when then these laws hit us, investors took away that benefit of doubt. And it's one of those reasons I believe our share is trading where it is today. What we've done with the group board, working with the NBK board, is we are taking a step back. And that's why I was confident when we were releasing the results, saying by the time we have another investor briefing, yes, I will have a position on NBK.
On NBK. All right.
But you see, look, think about it. Strip out the 3.8 billion loss from NBK and see KCB results from that angle. So I'm bold actually to say we've asked NBK between Q3 running to 31st December, they must strip out 1 billion of that loss. That's the target I've given them.
Which is quite ambitious.
And we are on it almost every single day. Yeah.
Okay. Paul, we must salute you for the improvement in your asset quality from an NPL ratio standpoint. But that is largely a factor of your denominator. The quantum number is still growing, 187 billion shillings, Paul. The last time we sat here, this very place, you told me the downgrading conversation is behind us. You've downgraded 44 billion.
So I think, Julian, you know, the problem with you guys is, if I may say that, is you don't see that downgrade happened for the half year, right? It's technically not new downgrade. What has happened is the impact of FX has equaled the 20 billion of recoveries. That's a sad story. Yeah. So we've made 20 billion recoveries, but then the provision additional NPL as a result of the depreciation of the currency was almost equal. So on face value, you don't see the effort, right? And 2 things, that's why I'm very clear in my mind. KCB will not focus on NPL percentage as a measure. We are focusing, and we've had a group strategy meeting last Thursday and Friday, on the quantum on the stock, right? Because it doesn't matter. You know, I don't need to be reminded that 187 is equal to number 3 bank in Tanzania. Julius, if you want, you know.
You can even think of it in terms of the Eurobond.
Somebody said to me, Paul, by the way, you can collect and then pay the Eurobond for us and we'll pay you. Now, there are jokes up to that point. Behind closed doors is hard work for some of us to be able to make that call. I'm proud of the work the team has been doing, you know, taking the quantum, managing the flows, migrations, and you know, being proactive in terms of that recoveries and collections. But you know, Julians, particularly in Kenya, you know, I'm on record. You win a court case in Malindi, somebody files an appeal in Kisii, right? It's not what I think a number of times people have said, oh, maybe you're unable to sell securities. No. There are people interested in a number of those names. Economy might be challenging, but the last 2 months, when I look at maybe 5 or so top names, we're not short of people to buy. But the circus around court cases and what people will do to delay those actions. But I say you've got to run that treadmill. Maybe that's why we have the jobs we have. Yeah? So we will reduce the stock of NPL. And that will be down to just the teams and the way we've set ourselves up.
Would, still on that issue of the quantum of the NPL, would 200 billion be a psychological mark for you?
No, we would not get there. Unless there's another COVID or some other disaster. I'll take a bet to say we will not get there.
I see. And is there a dedicated strategy towards your mortgage book? Because in the latest numbers, I think quite a bit of hits came from your mortgage book.
We do. And one of the things that we've done is, just to make sure that there is closer management. In the past, 2 or so years ago, KCB Kenya made a decision to break down the mortgage division and split that into retail and corporate. We've reversed that. It's only fools who can't change their minds. We've reversed that, and we'll regroup that team and a very experienced internal resource that was in the mortgage team. For a while, Caroline ran our mortgage as number 2, then she went to run the foundation. So we made that decision to bring that expertise back under Caroline Wanjeri.
So S&L is coming back?
That's a question even the board asked me. You bring S&L back? And I've just said it's probably step 1 towards that direction. You need a core team of experts. Yeah? And we are reviewing another strategy.
Okay. Maybe just to nudge you a little bit on that. So what informed that backpedal? Maybe just some more color into it.
I think it is, mortgage is, for lack of a better word, is a specialist product. And the value of running it under experts is something that we recognize. And I chose to make that call. I think and as well as if the direction on low-cost housing, and those clients of ours that are involved or would want to go that direction, I think it's better managed by experts. And also just ensure that you don't get yourself into risky spaces. Because it's also a risk management action, right? There could be a lot of appetite because of the direction the country is going, but you need experts to moderate that risk, in my view. And Julians, I've always told you, when you are a CEO, you better work through subject matter experts. And we needed to pull that expertise together. And KCB is too big to just rely on any other person. So we understand the corporate team is extremely good, but are they competent on that side of things? Am I asking the corporate director to do a lot more than what they can, or the retail team to do a lot more than they can? But as well as you can go to project financing, but who then ensures that the value chain is optimized, right? So it's one thing to sponsor, to fund a significant project, but the buyers are going to be retail or individuals. Who is optimizing that whole chain? I think I'm okay to take lessons. We were more organized, and you can also build expertise in the network. So experts training across the branch network, but also across the group, so that we're in a better position.
I see. Paul, the last time we sat here, unless I got you wrong, you gave me October 31st as the sunset date for recapitalizing KCB Kenya. Tier 2, 100 million USD. When I look at the numbers, it doesn't reflect, but that is until September anyway. How far are we with that?
A bit of a distance, to be honest. We were very optimistic, and I think that's one of those elements you keep holding me to account. Paul, you become too optimistic. We were running, that process. We were almost very sure about closing that out, but I actually see that getting now to January. Three parties, evaluating all that process. I just think there are lessons that we would internally have done a lot faster to be able to close that out. So you're right. Maybe we were too bullish.
Okay. And the ticket size is still the same?
Because I think, yes, the ticket size is still the same. But I think, Julian, we also should not underestimate the risk appetite that investors want to take on Kenya and Kenya-related entities. Yeah. So probably it's one of those that were underestimated. So they are reviewing Kenya as they review your consideration for that tier 2 capital. You're bullish about KCB, but there's a holistic, bigger review that will be ongoing, and I guess that came into play. And once you meet one board circle for those entities, you have to wait for the next one.
Yeah. Something stood out for me in your balance sheet, Paul. You're going countercurrent. Everybody seems to be cutting back on government exposure to government securities. KCB seems to be going cross-current.
I'm not sure that, they are cutting, but I think for us, we needed to say from an ALCO point of view, where is the best place to put in that money, particularly coming out of the G2G initiative. So it's a collective, ALCO decision. I think at the end of the day, you've got to optimize those decisions. I'm surprised that you now don't say that our effective tax rate came down. And that's what you guys used to beat us on, right? Just because of that investment in the infra bond. So we found that opportunity at the right pricing and went for it. We'll still continue to do that evaluation. I think, is it the long end or the short end? I think many people will prefer the short end at the moment. And we took that opportunity. And so you need to give us credit that we took that opportunity with the liquidity that we had.
$500 billion in guaranteed letters of credit for the G2G arrangement. Some would say you have outsized exposure on that side, 85% of the market.
So two things, and allow me just to revisit this G2G issue. Number one, Julian, this was a co-creation and conversations where most of us, I'll say at the start, there were 16 banks in that conversation, and I dare say so on TV, that we were staring at where oil marketers were struggling to get dollars. And all of us, banks and everyone else, were going to be impacted if we go to a point where there was outage. And maybe I might sound an alarmist, but signs were there. So this solution was to try and make sure that we've got a way to support the oil marketers. Now, before G2G, KCB ran 42% of the OTS in terms of support from a trade finance perspective, and it was growing. And we built a team around that, and that team has done extremely well. Now, through the process, three parties, won to be those that are involved in the G2G arrangements. Those were our customers. Like I said on Wednesday, the feeling is if you're human is you used to have 10, now it's only 3. So you can have a feeling for the ones that are not there if you now apply your heart and mind to it. But look, the whole process is the same as what was on the OTS. It's you have fuel or you have money, right? So the whole collateral management process is exactly as it was under the OTS setup. The risk here is when you start buying dollars to settle the LCs. So far, we've been able to retire a number of LCs. We've been able to prepay a number, which shows that the process and the model does work. Now, what you saw as breaking news in the front of the pages is the cumulative, right? So no one has looked at what we paid and how those fall and scheduling. Every single decision is approved in the normal way by the board credit committee, and we've got our risk appetite in terms of that set. So I think people looked at the numbers rather than the mechanism of how it works. You know, the current G2G from where we sit as a bank, you can flip it back to OTS, it will go ahead as the same. Obviously, you get backlash because you have more liquidity than everybody else. But Julian said, it must count that I took the risk. So on this other side, you're beating me for the risk. Now, then you start beating me for the liquidity on the back of that risk. I think for us, and the TRICOM, remember there's a TRICOM, EPRA, banks, oil marketers that meet weekly to review. As long as the TRICOM continues to work the way it's working and we are represented, we believe we've mitigated our risks.
And you feel the 91-day yield cushions you adequately on the FX side?
So far. I think we've got to start thinking about, and the way I view as a CEO, is what else for the country? Just what else? Yeah? And I can say here, I'm on record saying, you know, you better have expensive fuel than not having fuel. That's not the sustainable, don't get me wrong. Yeah. Right? It's not the sustainable conversation. Let me not wade into the politics side of it. But at that point in time, right? Because I don't think, Julian, that people have appreciated the impact of the shortage of foreign currency. You can have KES as an oil marketer. It's fine. But where are you going to buy dollars? We worked together with central bank for a period across the banking sector to prioritize oil sector. It became difficult. So I don't think G2G just happened for the sake of it, right? You've got sometimes even in strategy to stay away from strategy and go tact, which is a bandage and elastoplast. Yeah. That probably informed that. The question everybody should ask is, what's the long term?
Paul, you spoke about liquidity, and I noticed you closed Q3 with some exposure on the CBK window. Unlike what we saw in the half year, I thought liquidity conditions had improved much better in Q3.
Liquidity is tight. Boss,
that's the truth.
Liquidity is tight. No, I won't sugarcoat it. Liquidity is tight. I think for us it was, what is the optimal deployment, right? If you go to the window, does it give you an upside versus other available opportunities? Yeah. So if you went infra at 17, 16, right? And you got the other option that gives you some joe. Yeah. That's what the guys did in this instance. But Julian's liquidity is tight. Anybody who says otherwise, I would like to have a cup of coffee with them.
All right. How is TMB going? The last we spoke, you mentioned the prospect for cross-syndication facilities. Are there any new that have come through, especially looking at TMB, KCB Kenya kind of an arrangement?
There is, and quite some significant, not only pipeline, but the ones that we've closed, right? There is lots of opportunity. Obviously, you have to be very selective and choosy about it. But remember, Julius, what I said. And that's why we have to manage the capital of KCB Kenya correctly. We know why we are where we are, right? Is you can grow KCB Kenya by working with subsidiaries to cherry pick, right? And book. TMB is one of those entities. I think we closed a significant big name in cement manufacturing. Just shows the opportunities that are in there. So I truly see, opportunities for KCB Kenya working with the rest of the subsidiaries to grow the book. And at the end of the day, it's going to be interest income. But don't get me wrong, it will be selective, not just any name. To then remember, I have a target to make sure it's nothing beyond 187. You bring that stock down. Out of that for Kenya, there are a number of entities that were syndicated, right? So we have lessons and we've learned lessons. We are going to make sure that there is no repeat.
Okay. Paul, in your investor briefing, you spent the first 30 or 40 minutes speaking about market valuation. A good friend of mine always tells me that the moment you get C-suite executives preoccupied with the share price, then something is wrong because maybe they're questioning their fundamentals. Why did you go that route?
I think it is important that the discussions about the share price, including, as I said, somebody else who kept talking about market capitalization, came in the reporting period. So we couldn't say anything. Even for me who tweets, I couldn't tweet anything because it's a close reporting period. And therefore it was important to clarify that because shareholders have never lost that kind of value. And
40% plus down.
Yes. So they need to hear from you. And as a CEO, you can't keep quiet. And I thought that was the right platform to clarify that. But not just clarify, but also be factual of what I think are some of the things that are contributing to that and what we are doing for what we can control. And people can say we don't have control of investors leaving the country. We do. It's all hands on deck, right? All of us must try and contribute to make sure that the country is a safer destination for investors. But 42%. There are better destinations and returns, lower risks kind of destination. You underrate, but the individual retail fellows, two things will be playing in there. Some of them, because of disposable income, are trying to cash in for their own survival. Number two is they do not have that extra fund to be able to put in, right? Because of the compression of disposable income. But like I said, half-year result was a shocker.
For many.
Right? So that played a big role. The performance of KCB, the aggressive provisions, the KCB Kenya being 20% down year on year, made a few people question, including our own staff, whether some of us are the right people to lead the organization. I don't shy from that. I go to town halls and they say, boss, I almost ask you whether you know what you're doing. And it's the right thing for them to ask. When you are a new CEO, or not new anymore, but people will doubt you. People will question. I was asked, why now? Why are we providing? Those names are old. Why are we taking additional provisions? But Julian's, it's good to be big, but it's also good to be a bold leader. Because there's no need of kicking a can down. Right? People ask me, Paul, are you the only one in this market that is is suffering. Why is it just KCB? Signs have started showing.
Actually, peers have really ramped up provisions.
Exactly.
Now.
That
Yes.
I didn't want to be seen to be pointing out, but that's just the reality. And a few will have to do that to catch up. So bad news, deliver bad news once, if you can. That's what I was taught in change management. Two is you are the one who is there today. It doesn't matter who was there before, it doesn't matter who will come, it doesn't matter who else is around you. Take that call. Yeah. If you succeed to turn it, nobody will ever forget you. Yeah. If you don't, it will go with you. It's fine. But that's what leadership is about. You know, now looking at Q3, the spirits across the organization, it's just amazing. That is what we're using to dash to the finish line for Q4, because it's important. Same people, as you said, nothing wrong on the top line. Our staff are working as hard as they were. But I'm there to make that call, and I'm the one to go there and say, ladies and gentlemen, you are working extremely hard. It's showing a top line. We took this hit for the following reasons, and which I did across town halls, across the group. If you continue on that run rate and we control the migration, we're going to be good. But you will not have a surprise at the end of the year, which would have been a shocker. Can you imagine if you and I were sitting at the end of the year and I'm pushing that aggression of half year? Investors will give you a benefit of doubt. It's what you do with that window. But again, you know, in strategy they say first mover advantage is not just in innovation, it's in decision. Yeah. And finally, Julian's on that particular one, it just reflects that there are points that when I look back, I think the institution had points to make tougher decisions after. Right? And I know investors don't like this. We should not have paid dividends during COVID period. Should have protected KCB Kenya capital. Should you have funded TMB 100%? Because you remember it's KCB Kenya that has to pay dividends for that acquisition. That's exactly why we're here. Right? Now, the good news is KCB Kenya generates.
Organically.
It's how you protect that to create sustainable value for shareholders. Right? And it's fine. We are the leaders who are there today. You make that call. And I think most importantly is how do you explain to shareholders, to stakeholders. That's why it took that time to say, let me be bold and explain as well here.
Paul, let me ask you, I've spoken to you 3 times and I get the sense as though KCB's dividend policy has either changed or is about to change. At least that's the intimation I get from you.
No, the policy has not changed, but we will not...
Is it about to change?
We will not... Policy will not change as well, but we will not just pay dividends because we have to. Right? It is build a sustainable organization. And it can generate more dividends downstream, if you get what I mean. Look, by paying dividends to the group to acquire TMB, you've made KCB Kenya be where it is today, and therefore constrain the growth, yes. Isn't it? And so it can be fashionable, but then you can cause a dry dividends period downstream, isn't it? So it's more about more informed, strategic kind of conversations, for lack of a better word. So policy will not change. Trust me, I would love to drive the organization to a sustainable that it becomes the best dividend-paying institution here. But I won't risk the sustainability of particularly the cash cow, which is KCB Kenya. You've just said that, you just heard me say, I'll still bet on KCB Kenya. So we have to feed it in the right way. Was I there when we made the decision to pay dividends to buy TMB? Yes. but only a fool doesn't take lessons.
Okay. Paul, there's something you mentioned in the briefing which I caught very briefly and missed, is the revenue from Hustler Fund is 58 million?
Up to September, it was around 58 million, top of mind.
Just give us some context into that, please.
So, you see, at the end of the day, so remember let me try and explain this Hustler Fund, and I hope I can. It's a product by the government. Yes. Different parties came together to try and make it happen, right? We have the capability, the credit risk modeling. The telcos had systems expertise as well. So collectively we came in together to operationalize that. Now remember there's a fee of the interest that is charged. Yeah. So however small it is, that is what we had a revenue share model, right? Where there are particularly 4 components of it. One is to plow back to the fund. 2 was for administration for UK. 3 is for telcos, and 4 is for banks. But the value is low, but you are not out of pocket. And my 58 was just to say it's not for free, it's not out of pocket. Yeah. But one of the biggest lessons for us is kind of we tested our credit risk modeling, and I'm glad that it came spot on to what the team modeled. So it's not about making money, for lack of a better word, but we said there was some value that is being generated, so we agreed a revenue share model for all the entities.
I see. Okay.
But you remember, it was, again, it's on the back of answering a question, because everybody thinks the NPL is with us. Now, if you answer and they don't, right, Julians, I don't know what to say. But that was actually the core message. Yeah. Is we don't have an exposure, and then I just stated the fact that we made 58 million or thereabout from the Hustler Fund, and because we system-wise, credit risk-wise, the question today is how do you bring all those parties to give expertise to government for collections, right? And that's the conversations today, because you have some amount that is out there. Yeah.
Okay. Someone asked me that in your first sitting with Paul Russo, he mentioned there's a designation of a special assets recovery team, which sits directly under his office. Do you think those guys are delivering the punch that we expected?
They are. They are. The team is working hard. But like I said, if everybody can file cases everywhere in this country, yeah. Julians, I don't sugarcoat. Yeah. Making recoveries, right, at the end of the day, is you've got to balance it off, but you have to do it within the confines of law. So we'll continue to battle some of them in court. But ideally, and this is the message I push with that team, is let's find a way to not have to go to court. Either you get the business back on its feet, or you agree the person can dispose and you agree of the payment on their own, or we both look for buyers and get the best of the value under private treaty. I think it's work in progress. But I wouldn't say that those guys are not. Otherwise, the 20 billion, where would it have come from, Julians? It's just that you don't see in the numbers and in the short time that the presentations happen. Yeah. More reason why, going back to the question you asked me, I actually had to spend a lot more time than usual, right, in the presentation. Because meaning is in people, not words. And what we've learned actually is we will be going out there to tell our stories. And I'm glad that we chose to have that session on that particular day. And this afternoon, 4 p.m. with investors.
Okay. As we wrap up, digital lending is up massively. Quite some momentum I saw there. And What drives this? Is it about the macro factors? Is it strategically, internally, KCB saying we want to push through this channel?
I think both.
Yeah.
Both. Let me try and see if I can put in my own words why I say it's both. Internally, it's better use of your liquidity because the chance repays faster, right?
Yes.
Better margins. And therefore, if what I said is right, that you have the best credit risk modeling guys and you have the best technology, naturally becomes
Makes sense
to focus on that, isn't it? I have nothing against corporates, but they'll come, ask for big values, lower margins. They ask for moratorium first before you can. So it's better value, actually, in all measures for us. But we've built capabilities. We have systems, invested in, the best of the Huawei system and the other system. But it also gives you better margins. The reality is, as people downgrade, and I hope you get what I mean by downgrade, then becomes a destination. So yes, what is happening out there is also a driver. So you complement, supplement, whichever term you want to use with what you've been doing. The reality, Julians, is people are downgrading, whether it's houses, limits, that's the reality. I think it is about how we can support those people, and that's why we're very clear on risk-based pricing, but not to be, extremely opportunistic on that side, but you run a game of volumes, right? And that's why it should count. So that's why we've come in with new products, whether it's for merchants, new term loans on mobile for our people. We've automated salary advance 100% for that purpose. What I think is important is replicating those products in other markets. That is my focus. So we're about to go live in one of the countries. Pilot done, approvals in place. When I was Group Regional Business Director, that is what I was hoping for. Now that I'm the CEO, I need to give that capability to subs.